Hi, I'm Tim Kelly from Montgomery Investment Management and welcome to this week's Video Insight. As many people will know, the Montgomery Fund has for some time held a reasonably high cash weighting of between 20 and 30%. In a market where share prices have tended to only go up and with interest rates at very low levels, that cash weight has certainly been a headwind to returns. However, in a market where value has not been easy to find, we're happy to hold cash for a couple of reasons. For one thing, we think that a good investor needs to be just as concerned about risk as they are about returns, especially in the good times. And holding cash when prices are high is an important part of protecting against downside risks. Another reason is that we think that if we're patient, we should see an opportunity to invest that cash at better prices than are available today. In October, that window of opportunity started to open, and so we have started to invest some of the cash in the Montgomery Fund. The change in market valuations hasn't been enough to trigger dramatic changes in the fund, but the fund has increased some position sizes and is looking at possible new positions. And instead of a cash weighting above 20%, we're now aiming for a cash weighting in the mid-teens. Of course, it's not always easy to follow the discipline of investing when the market falls. Whenever the market declines sharply, as it did in October, the natural question to ask is whether this might be the start of something more serious. And it's very easy to construct a narrative as to why it may be the start of something more serious. For example, we could argue that globally equity prices are high, largely because interest rates have been low for a long time, and interest rates have now started to rise with obvious consequences for equity markets. However, equity markets are very seldom that obvious, and we are firmly of the belief that a disciplined approach built around valuation is much better than getting caught up in trying to work out where the equity markets will go next. We can't say with any certainty whether equities will be cheaper tomorrow than they are today, but we can say with certainty that they are cheaper today than they were yesterday. And it follows that if we were willing to own equities yesterday, we should be more willing to own those same equities now that they represent better value. When markets become volatile, we often see investors wanting to do the exact opposite, selling equities after the price has dropped in order to avoid the risk of further declines. When that happens, the prices for good quality businesses can be unfairly punished, and investors who are able to remain dispassionate just may be able to pick up some bargains. So we'll be watching with interest to see what happens in the months ahead. That's all for this week. Thanks for watching, and we'll be back with more next week.